Good afternoon and welcome to today's presentation and Q&A with Schiehallion. We're very lucky to have Lucy Mastrova with us today, an investment specialist at Baillie Gifford, who works on the private companies side of their business. Before we get going on the presentation, I'd like to highlight that there'll be a Q&A at the end of the presentation. So I'm sure you know about this, but there's a box in the bottom right-hand corner of the screen. If you submit questions there at any point during the presentation, I'll collate them all at the end and address them to Lucy. There will be a recording of this presentation available online shortly after it finishes, as is the case for last week's roundtable webinar, where Lucy and the managers of two other private equity trusts discussed the prospects of a recovery in private equity NAVs and share prices. So please do check that out if you haven't seen it before. So without further ado, over to Lucy. Thank you so much.
Thank you very much, Billy, and thanks to everyone for dedicating our lunch hour to hearing about Schiehallion. I think, if there's one thing I would like to leave you with today, it's really the importance of growth equity or private growth and how much it has grown in the recent years to the point we actually feel it's quite hard to ignore. And obviously, I will do my best to convince you that if you're going to invest with someone, you should do that with Baillie Gifford, but we can see how well I do on that part. So let's talk about private growth and in general the composition of the different private markets and how they changed over time. So what I've put there on the slide is essentially private market AUM over time. And one thing that you can see very clearly is that it's grown over time a lot. And you can see, buyout, which is the gray bars at the bottom, there are a substantial chunk. You can see, the rise of venture capital there in the dark blue. But what I'd like you to focus on is also the emergence of growth, which is the reddish color there, from essentially close to nothing back in 2013 to today. It is roughly a $6 trillion asset class. And is this something new? Is this something, why has this happened? And these are companies that essentially delayed their listings. And we started investing in private growth back in 2012 when we're seeing this trend for companies that we were meeting, we understood them. They were similar to all of the companies that Baillie Gifford as a public growth investor would normally invest in, but they were staying private and they were staying private for longer. So this was leading to a frustration among our managers that would have loved to access those for our clients, and our clients were also reasonably getting frustrated. So this is where we started investing in private growth in 2012 with our first investment in Alibaba. And since then, we've deployed more than 10 billion to over 160 companies. And really, at first, we were not sure whether this was a short-term situation that was a product of the zero interest rate era, but this has actually proved to be a structural change in the market. And why is that? Why can companies delay their IPO? Why would they want to do that? As part of it is that the life in the public markets has become much harder. There's various regulations like the Sarbanes-Oxley Act that makes it much more costly to be a public market company. But there's also the change that we have observed over the last 1 or 2 decades in the change in market participants in the public markets. We all know about the rise of indexation. And what it also meant as a knock-on effect is that the market broadly, the public market, is much less accepting of smaller IPOs. So the companies that were about to go public, they were facing a less accepting environment. And also, so that's on the sort of, let's say, on the demand side for smaller IPOs. But then what they were also found is what they were facing is an environment where there's an increasing availability of private capital to support their growth. And what they saw is that the private markets are actually a much better environment to build a company for the long term. They can focus on the long-term prospects, they can stay unprofitable, and if they can get the funding, it's a much more accommodating environment to build a long-term project and then go and IPO longer. So IPO a bit later. So that's why the growth equity or private growth emerged as a distinct asset class, because these are companies that already have a product, they have an established market for that product, and they are scaling really rapidly, but they are still staying private. And quite often they would cross them over to profitability while still in the private markets before IPO. So really, this is the vice of the private growth equity. And I think what we're also seeing there is on the public market side, it is skewing the valuations in the public markets, because so much growth, so much fast-paced growth is now happening in the private markets. There's not so much of it going around on the public market side. So, you have all read and seen the vast concentration of the public market indices in the States on the Magnificent Seven, on a narrow set of companies. And the reality is that on average, the Mag 7 are growing revenues at around 20%. So then you compare it with the private companies, like the private companies who are investing in, that, on average, when we're first investing, are growing revenues at north of 70%. So you can see, how there's the discrepancy between where the growth is, but then, most participants that want to buy into these companies only have access to the public market. So that's why that's why there's so much concentration. That's why the prices are being bid up. And that's why we then also see that the valuations are more attractive in the private market. So let's say the structural overview. Let's move on and compare a little bit the different types of private equity, because I'm also quite conscious within private growth, a lot of the questions we are getting are coming from people who are more used to buyout and this type of private equity investing. So I think a good way to start is just think about, what is the proposition here? How are returns generated in growth versus in buyout? So you'll see here two charts as a comparison. On the right-hand side, you have what happens in buyout. And what you can see there, that, there is some value generated from revenue growth, but then also you need to be working really hard on margin expansion, there's potentially some leverage being put on, etc. And they are both quite significant parts of the total return. And that's why, buyout managers place such a focus on controlling the companies and making them better, making them a better business. Now, like very hands-on. And then you switch it to growth. And actually, in growth, the vast majority of the return is from revenue growth. And that's why we focus so hard on finding companies that are not just growing really fast now, but they can sustain a fast revenue growth over numerous years to allow for this compounding of revenue. Because what we know quite often, we will get hammered on the multiples. There's going to be a lot of compression on the multiple compared to where we're buying. Then you're going to absorb some dilution, but still the total returns can be very attractive if the revenue driver is really there, if you've picked the right company that can grow the revenues. Because what happens also at the same time for the right companies is that as revenues are growing, the unit cost are decreasing. So the profitability is actually increasing faster than the revenue growth. So they are driving towards profitability, the operating leverage kicks in, and really the switch to profitability quite often is a big inflection point in their valuations. But as I mentioned before, this is something that now happens still in the private market. Now, also, how does growth compare to venture? Because everybody's much more familiar with venture, all this explosive growth that happens there. And I think it's actually a more interesting comparison between venture and growth than venture and then growth and buyout, because I find growth and buyout, it's a completely different types of companies you're looking at, versus venture and growth are more on a continuum. And essentially growth, as it happened, placed itself in a gap between venture and the changing face of public markets. So these are typically companies that outgrow venture, they have a product, they don't need to be so hands-on, and they've also de-risked massively. So what you can see on the right-hand side is the default rates of our portfolios, the loss ratios, which means, once we don't recover our initial cost, how much is actually lost. versus the first growth loss ratio, so the market. So you can see at Bailey Gifford, actually a loss ratio in the, let's say, mid-teens is better than the market as such. But then also compare it to venture. What if venture, really the game is investing in a number of companies, knowing most of them will go to zero, but then you will pick some real winners. So at the point that we are investing in the companies, because they have a product with fast growing revenues, it reduces the risk profile massively. And now, what is the revenues that are on offer? How much more it can still grow? And I think here, what we would say is actually it's not dissimilar to venture, it just takes a bit longer. And I think we mustn't forget about compounding returns and what it means over time. Let's say if you're compounding 35% revenue growth over 10 years, you get to 20 times your returns, so 20 times revenue. So here, examples of 3 companies: Wise, the money transfer company, Affirm, which is buy now, pay later company in the US that's actually entering the UK now as well, and ByteDance, the owner of TikTok and other social media apps. And we've invested between 2016, 2019, and the fast-paced revenue growth has really compounded over time to give you these huge multiples that you can see there on the screen. So really, just hammering it home as what I was saying before, it's not just about the starting rate of revenue growth, but we're really focusing on how durable the growth is and the quality of the companies, how they can sustain a fast-paced growth. Now, just, we've talked about growth as an asset class. Let's just formalize it a little bit. So where we invest is a valuation of at least $500 million. In reality, the range is anything from there to, I'd say, 240, 250 billion. The revenues, we want to see real revenues, so at least 50 million, growing at least 35%. But again, in reality, I would say the average company has revenues of more like 200 million a year and growing at more 70 to 80%. And quite often we'll be investing just before they reach the threshold of profitability. So really, it's a time when companies are scaling really rapidly. They have a product, they're taking to market and growing to profitability. And I think what you can see there on the right-hand side is essentially, the emergence of growth, how the shifting IPO timelines has allowed for this asset class to exist. Just to give you some numbers around there, because I'm saying here, we want at least a 500 million valuation. In 1997, when Amazon became public as essentially an online bookstore at the time, it was valued at just under $500 million. So actually would not even be eligible for one of our portfolios. And, another example, Tesla, when it went public in 2010, was valued at around $2 billion. So if you're looking at, a comparison, SpaceX today valued at $800 billion, it's 400 times difference. This is, this gives you an idea of the scale of how much the market has changed really, and what types of companies we're looking at. Because when you look at, when you look at the stats, we're really looking at mid to large size companies that are growing very, very quickly. And let's look at some companies, because I think that's where it gets fun. And I think it will start, it touches on how we think about the durability of the growth, because we are looking for companies with business models that allow them to scale and with really good business modes. So we're looking at business models that are extremely hard to replicate and that get better as the companies get bigger. So here we actually have examples from the top 2 positions in the Schiehallion fund. And the first one on the left-hand side is actually an example from Vending Spoons. So Vending Spoons is a company based in Milan. It's a very acquisitive digital product business. So they acquire consumer applications. And what they do with them is they integrate them on their platform and use the immense talent and their set of tools to make them better, both as products, but also as businesses. So they acquired names like Evernote when we first invested in 2023, and you might have noticed the headlines through this year when they've been acquiring more household names like Vimeo or Eventbrite, or then AOL America Online. And what they are really tapping into is the talent pool that they have built up, and they turned actually Milan into a huge hub for tech talent. Because what they offer bright young engineers is the ability to work across numerous products and to just make them better, learn, and move on to the next thing. So when they are acquiring companies like, for example, Evernote, that's, maybe at the time has become a bit stale, has lost its growth, the engineers that were working on the company in the US, they were hardly, they were not the top tier, because anybody who's top tier in the States doesn't want to work for Evernote, they want to work for one of the AI companies. But Bending Spoons has become such a talent magnet that actually last year, I think the latest number is that they had 800,000 job applications for very, very few open positions. So they really have the top talent, and really the magnet for talent, and the online, and a set of tools they use to improve the companies have become such a huge business model that even though the idea sounds a little bit, sounds quite simple, let's acquire, digital products that maybe haven't reached their full potential, they haven't reached their full destiny, let's make them better. Like the way that Bending Spoons does it, they have pulled so far ahead of anybody who else would like to replicate it, that the momentum is really very hard to stop. And the second example there is from SpaceX. So the second largest position in Schiehallion. We've held SpaceX since the start of Schiehallion. Was actually the very first investment in Schiehallion. And I think what was, at the time, it was actually an interesting project, but where there wasn't consensus so much in the market was when it's going to be an interesting business. But actually what they managed to do is to effectively create a new business line and come to dominate it. And they've pioneered the reusability of the rockets. And essentially they've managed to bend the cost curve down so much that the next competitor is just so far behind them in terms of how much it costs to bring a kilo of cargo into space, that they just, there's not even a comparison. So all of this then flows into the bottom line, and it's so hard, would be so hard for anybody to catch up. And in fact, with the next generation of rockets, with Starship, we're talking about, again, another big leap towards more capacity, which then again would make it much cheaper for kilo of cargo to be taken to space. And this then opens up a new leg of growth for them. Because, for example, when we first invested in SpaceX, Starlink, so the online constellation of satellites that provides access to internet wherever you are in the world, was more of a new project. We didn't know whether it was going to work. It sounded like sci-fi, that you'd be in the middle of the ocean and just browsing online. But now it's a very cash generative part of the business. And now the next potential leg of growth is through the radical reduction in the cost of taking things to space, basically enabling them to start producing stuff, manufacturing in space. So the sort of cost reduction we are looking at for Starship, it's going to basically make it about as costly to manufacture stuff in space as it is today in the high-tech business hubs in Taiwan or California. This is really important because we spend a lot of money recreating some of the conditions in space that, on Earth, that are available in space for free. For example, the vacuum, etc. So there's a lot of things that we do on Earth that make it, quite costly to produce semiconductors that we can actually do in space at much lower cost. So if this happens, again, it opens another leg of growth, and it allows SpaceX to build on this competitive advantage and on this incredible moat that they have to continue their fast pace of growth. And again, it's a very profitable company already. Now, I'm telling you all of that, all very exciting, but how much do I pay for all of this growth? So this is a very busy graph, but let me make it very simple. On the horizontal axis, what you can see there are rates of growth. So the further to the right you are, the faster the company is growing. And then on the vertical axis, you have the revenue multiple, so the price to revenue multiple, so how much I'm paying for the growth. So essentially, you want to be as far down and right as possible. And what we are showing here, so all the gray dots, these are public unprofitable companies. So the best comparators for the companies that we are buying right now in the private market. So the gray ones are the publics. And you can see all the red dots. So these are all the purchases all the new investments we've made in the last 12 months. They are all to the right of the public comparators. So what this tells you is that actually the multiples we are paying for private growth are much lower than in the public markets. And hints at what I was saying at the start, that there's so much concentration in the public markets and the little growth that people can find. And it's driving the prices up, and there's actually way more growth available in the private markets. But unfortunately, the access to these companies, it's not quite so widely distributed. And if you want some numbers, I think for Max 7, the price to sales multiple is around 8 times. Like in the private markets, you're getting growth of what we're buying over 70% compared to 20% for Max 7. So you're getting growth at 70% and you're paying around 12 times multiple. So really, it's the private markets are paying much less for the same level of growth. Now, this is all good, but how can I be a good private growth investor? And I think the first point that we are making is that actually Baillie Gifford has been investing in similar companies, in growth companies, ever since 1908. And it's about identifying the determinants of enduring growth. So we invested in Amazon in 2004. We invested in Nvidia in 2016. So we have the experience to analyze them and recognize the patterns that determine whether the company is going to be able to sustain growth for the long term. And that's on the analytical side, and we set it up very deliberately, such that our public markets and private market colleagues actually work side by side. So there's a lot of learning that goes both ways. Our private market colleagues, when they're analyzing a new company, so for example, when we're investing in Bending Spoons, it very much reminded us of Constellation Software that does something very similar, but in the enterprise software, so we can share this research, we can talk to each other. But on the other hand, also when some of our colleagues are looking at Snowflake, which is a public company, they also talk to us and talk about Databricks, which is a private holding and a competitor. So there's a lot of help going both ways. But I think what's also really key in private markets is access, right? So we can pick these names of companies, but we can't just, you can pull out your phone and buy Amazon shares. You can't pull out your phone and buy SpaceX. So how does it happen that we can invest in these companies? And I think the key point here is that the private markets are not democratic. The best companies can choose their shareholders. So why do they choose Baillie Gifford? Why do they want to work with us? And I think that's, again, the joint up public and private investment platform becomes incredibly attractive. Because a lot of these companies, what they're looking at, they're incredibly ambitious, quite often still run by their founders, and they don't want to be acquired. They want to build a generational business, and they want to eventually enter the public markets. So it is our expertise, it is our network they are tapping into as they are growing to the IPO stage. But then there's also the potential, never hard promise, but the potential that our even larger public mandates can buy in at IPO and carry the relationship for the long term, and we can become even much bigger shareholders then. So for example, for Spotify, we first owned them privately, and we are still one of their biggest shareholders on the public market side. So this is why private companies that have this level of ambition love working with us. And I think, now we're getting to the Schiehallion portfolio, and that's why you see on the left-hand side, these bars, they are the top 10 world's largest private growth companies. And the bits that are shaded, so the SpaceX, the ByteDance, Anthropic, Databricks, Stripe, and Revolut, we are all investors in. And the rest, we actually could have invested if we wanted. So we had a look, and for various reasons, quite often valuations, we've decided not to invest. So I think this, really speaks to the level of access we have to the world's largest companies. And they're all, very valuable for the portfolio, but I think I would also like to highlight that it is our access to the other types of companies like Bending Spoons or Wave here in the UK or Tekeva in Portugal that is very good for performance over time. And that also speaks to our ability to access fantastic companies. Because when we're investing in Bending Spoons in 2023, the company did not have any other institutional shareholders. They completely grew outside of the venture capital system, and nobody heard of them. And they were, at the time, they were looking for someone to be a partner to bring them to public markets. And they were speaking with the advisors who then suggested they speak to us. And this is how their relationship was developed. Similar to Kepler is a Portuguese defense company. And that one, again, did not have any external institutional capital, but they were looking at the path to IPO, and that's when we came in as investors. So it's also uncovering these companies that the VC universe is not necessarily familiar with and not on their radar, that can really help us make a very nicely diversified portfolio and drive the returns over the long term. So here we are showing the Schiehallion portfolio. Schiehallion is listed on the LSE. And since the 10th of December, it's actually as a part of the listed segment of the main market, which means all the participants at the LSE can purchase shares. It trades in dollars and sterling now as well. And we believe that at the next revision, it's also going to become a FTSE 250 company, but this is something still to be confirmed. I think it's a nice way for the broader market participants to be able to access these companies, because we also do, this sort of GPLP, limited time funds, but the Schiehallion is much more widely accessible. And now let's just have a look at the portfolio characteristics and maybe to dispel some myths around, what are these types of companies? Are they vastly unprofitable, etc.? So just to put some figures around it. So on the left-hand side, we're looking at growth, and that's the revenue growth. So the portfolio companies are growing really, really strongly. What you can see there is in the dark blue is the revenue growth either of the top 10, top 20, or the overall portfolio. So on average, the portfolio is growing at about 50% its top line. And this compares to 19% when you look at the NASDAQ 100, so the tech-heavy index, where the biggest constituent is NVIDIA. So as I was saying before, and hopefully, I've said it 5 times, so hopefully it's sinking in, there's way more growth among these companies. Now, around 60% of the portfolio is actually exposed to profitable companies. And I think that's, a testament towards the top of the, let's say, top 10 list. When you look at the Schiehallion portfolio composition, these companies are typically profitable, and very much so. So again, when we first invested, about 20% of the invested capital went into profitable companies. Now it's 60. So it's showing the maturation, the portfolio maturation in the holding companies, and really some leaders pulling away. And they're also resilient. So outside of the public markets, what we really need to track is the cash runways. So if they were burning cash at the current rate, how long would they be able to sustain their operations for in absence of further capital raises? And again, we can see here, it's more than 3/4 of the portfolio that either is actually cash flow positive or has more than 4 years of cash on their hands. So really, these are more mid to large cap companies that are growing really fast, and then more than half of the portfolio is actually exposed to profitable companies. So Billy asked me to speak for 30 minutes. I'm very pleased with myself that I've actually managed to keep it bang on time. So I'm wondering, Billy, do we have any good questions coming through?
We do. Thank you so much, Lucy. That's really great. So there's one question which is sort of two-parted, I think, which is, and it's slightly looking to the future as well. So I'm expecting you not to be able to give us a precise answer, I imagine. What percentage of assets will be IPO'd or exited in 2026 or 2026 or 2027? But also, what percentage of assets should be revalued. And I suppose the first question is probably relatively simple, and maybe the second part of the question is, well, maybe you could just explain your valuation process, which I think is fairly formulaic and good, but probably quite important for everyone to understand, because obviously that's the key part of what makes up the NAV.
Yeah, very, very happy to do that. So in terms of, IPOs, I'm looking for my crystal ball here, but it's gone missing. Like, we've all seen SpaceX is very publicly talking about wanting to IPO. Now, whether it's going to happen also depends on how markets are behaving, etc. But they've been very public about their intention. I would say when you look at, so Bending Spoon, SpaceX, ByteDance, Databricks, Stripe, they're all strong candidates for an IPO. They're operationally ready. Now, when it's going to happen, we will see, but they are all companies that are of the size and profitability and all these things that, can lead them to an IPO, let's say in the next year or two. I think ByteDance, what we're waiting for was the resolution of the situation around the US TikTok, but it seems that we're getting to the end of the process for the Americans to be happy with the situation. And they've been signaling to us a lot that, they do want to be a public company. And I think that's where, sometimes companies say a lot of things in the press, but what we also see is we run these sort of retreats in the Highlands for private company CFOs and, the other things that we help them with board composition, etc. And this is all geared towards being a listed company, helping them be much fit for the public markets. And they do come. ByteDance always come. So if you can spare your CFO for a week to go to Scottish Highlands, I think that you're taking your path to an IPO very seriously. So I would say among the biggest ones, this is their ultimate destination. They are so big that they can only really go into the public markets. The exact timing, I'd love to know, but unfortunately, this is not up to me. Now, on the valuations, so we have a very robust valuation process. What happens is that it's away from the investment team. So the investment team does not mark their own homework. What we have is a valuation group composed of other internal colleagues within our valuations team and other operations teams, but they do take external advice. So it's S&P Global that basically sucks in all the financial data we have from companies. They run public market comparators, and they give us suggested valuations. We can then debate with them, disagree sometimes slightly, but by and large, we're all on the same page about what the company valuations should be. The policy is that every holding should be revalued at least 4 times in a year. But actually, I would say for at least 75% of the companies, it happens more than 4 times in a year, because we also not just wait for the next deadline when we see a trigger event, for example, a transaction in the market, or if we see a strong diversion of their financials compared to plan, then again, we would just proactively revalue the company.
Thank you, Lucy. One question, and the move to the main market obviously has been a positive one. Certainly, if you become a FTSE 250 member. Previously, you were part of the specialist funds market, and I guess some platforms have historically made it hard to buy Schiehallion. Is it fully open to all investors now? Because one, I'm not going to mention the platform, but one person said that they have been prohibited from buying it, and I don't know whether that's specific or general. So do you know anything about that?
Yeah, so it should be all good, but we're also hearing, thank you for raising that. We are hearing anecdotes of the platforms not having been updated yet. So we are going out to all of the platforms, making sure that they have updated their systems. So hopefully it's not going to take too long for them to get it up to scratch, but we send them all the information on the 10th of December. But unfortunately, there might have been some delays in the system. So even if, you want to raise it directly with our clients teams, or if you want to, and we can prod that particular platform if if we don't want to share that on the webinar, or, you can also contact your platform directly. But in terms of regulatory constraints, it should be open to all right now.
Fantastic. Any further questions from the audience? I've got one more, so if you can think of one while I'm speaking, then please do type it in. Last question, I guess, are there any specific sectors or types of companies that you avoid on principle? And obviously noting that obviously in the slide that's open now, there's a few that you decided not to invest in. Does that tell us anything about what type of investments you don't make? Or
so there's no systematic exclusions, right, on sectors or anything. There's nothing systematic like that. I think, for us, it's about investing globally and across sectors. So what you see in the portfolio, this isn't, this isn't an AI fund. It's also not, I wouldn't really describe it as a tech fund. For every single investment case, it's very much bottom up. And we underwrite every single investment on possibility that this is going to be at least a 5x over the next 5 years. And this is what we're looking at. So for the companies that we've passed on, in the case of OpenAI, at this time, it was questions still around the legal structure, because when the round that we're looking at, there was still, they still had the charitable status, and it wasn't clear who the proceeds are going to flow through, but there was also just a question around the sustainability of the business model. And then there were others where we just felt they were priced too high. And, I would say that's the most common reason for us to pass, if we feel that at the valuation that's being proposed, we can make a good case for a 5x upside.
Fantastic. Thank you, Lucy. There's no other questions. So you've done a very good job, obviously explaining the Schiehallion proposition. Thank you all very much for dialing in and spending your lunchtime listening to us. NB Private Equity Partners is presenting the same time tomorrow as part of this mini series on private equity. So please do dial in on that. And as I said, the presentation will be recorded, so you can access that later. So thank you very much, Lucy. Very kind.
Thank you very much, all. Have a good afternoon.
Thank you. Bye.